2026. This morning, we're starting a new piece of our opening playbook show. We're going to be starting about 10 minutes early each day and going over some stuff about opening playbook and about the webinar platform that we use here, particularly for new people, but for anybody who is here early and hasn't heard it before, it might be helpful. So let's dive right into that, and then we'll get into our regular show. So whether you're new to trading or just new to our group, I want to welcome you to Opening Playbook. Opening Playbook is a bridge for both new and advanced traders to go beyond outdated narratives into deeper understanding. We offer market insights, timely analysis of what's moving the markets right now, trading education, helping you build real skills beyond surface level tips and tricks, and live trade ideas, real-time recommendations you can act on immediately. Opening Playbook is a free daily live webinar and stars Nathan Tucci and Graham Linman. Nathan has a decade of experience trading Forex, stocks, and beyond. He's worked with dozens of leading global experts on strategy development. He's obsessed with math and systematic edges in trading. He's the creator of the Income Machine, overnight options, and a lot more. He's a husband, he's a dad of 7, and he's the publisher here at the pub. Graham has been an options expert with over a decade of market experience. He studied technical analysis under 2 of the top minds in finance. He developed his famous wrap orders for option trades that are cost-effective entries, and he created programs such as lightning trades, moonshot alerts, NVIDIA Elite, Apex Indicator, and Newton. A lot of people in the stock market, education industry, will tell you that trading is easy if you just know their quote-unquote secrets. Well, that's not us. We are here to give you the hard truth that trading is complex and it takes time to learn. However, we make that learning process much easier for you. The main reason that the opening playbook exists in the first place is that a lot of traders have trouble succeeding because they believe many of the myths that are out there about the market and trading. We help to dispel those myths and equip you to become a better, more mature trader, giving you the opportunity to be more successful. Whether that means using our systems, tools, and strategies, or just trading on your own. Remember, our goal is to be a bridge for both new and advanced traders to go beyond outdated market narratives into deeper understanding. Now, this is very important. You should remember that you should never trade with money that you can't afford to lose. Now, obviously, nobody likes losing, but there's a difference between losing some of your investment portfolio and losing the rent or the grocery money. Let's be ultra clear. Any type of trading involves losing some of your trades. It's inevitable. Controlling your risk will help keep you in the game, and we can help you learn structures and strategies to do just that. So our promise to you is that we'll be honest and transparent with you about what works and what you should make your own decisions about, and what rules we believe you should always follow. Some rules of the road to start with are that you should stay calm, go at your own pace, and ask questions freely. To help you get started in your trading journey, we'd like to offer you some free information. Answer a few quick questions by clicking the link in the banner I'm popping up right now. And we will give you custom content to better help you during our sessions by using your feedback to help improve our classes and education. And we will give you a free options cheat sheet, a digital, easy to understand options guide that looks something like that, but a lot less blurrier when you get it. Now, since a lot of people are fairly new, I want to go over our webinar platform that we're using here, that you're watching this presentation on right now, to give you some tips to maybe use it better and get more out of our presentations. You can click what we call the hamburger icon, those 3 horizontal lines at the top left, to reduce the size of the green column and give you a little more screen real estate. You can hover over or tap on the main area where the presentation is and click the speaker icon in the lower left to mute or unmute the sound. In the bottom right are two icons that you can use to change the size of the display. You can use the double arrow to go full screen, or you can click the little rectangle icon to show the picture in a picture, where you can continue watching the presentation while doing something else in the background, but that is device dependent, so not everybody will see those options. There's a little monitor icon below the display. You can click that to maximize the size of the presentation without hiding the chat area behind it. And I really recommend using this feature because it'll give you the best view of what we're presenting without preventing you from seeing the chat. And then there's a yellow slider button underneath the video area called the low latency slider. You can click that if you find that you're having poor video or audio performance. Give that a try. The column on the far right is the chat area. The large area that takes up most of the column is where you'll see everybody's chats. And the bottom area where it says your message is where you can type a message and hit enter to send it. There's a green bar at the top of the chat area that has a few icons on it. The far left icon will collapse the chat so you have more screen real estate for the video, but you won't be able to see the chat anymore. So I don't generally recommend that. The megaphone icon or bullhorn will show you the announcement section. Now, we use the announcement section to post any live trades that we take during the session, and there's always a static set of helpful links in there that I highly recommend you go through and grab as many of them as you would like. You can click the double speech bubble icon to go into private message threads. You can private message any of the presenters so that only they will see your message. And then you can use that speech bubble with the three dots in it to get back to the main group chat at any time. Last but not least, that far right icon will allow you to pop the chat column out into its own window if you want to be able to put it in a different window and then full size the presentation in the original window. And that's it. So once again, welcome to Opening Playbook. Don't forget to complete the survey that's you can get to by clicking that link in the banner above. And we'll be getting started in just a couple of minutes.
Flip the page, it's time to start the game. Graham and Nathan calling out the names. Opportunities knocking loud and clear. The market's playbook is finally here. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh, charts are lighting up the morning sky. They spot the trends with the hawk's eye. Options and plays in a live display. This is where the big plays are made. Oh, charts are lighting up the morning sky. They spot the trends with the hawk's eye. Options and plays in a live display. Every move counts in the game they play. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh, step by step they break it down. No confusion, no spinning around. With every trade they set the tone, making big calls from their trading throne. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh, this is where the big plays are made. Oh, Strategy sharp like a razor blade. This is where the big plays are made. Oh.
All right. Good morning. Welcome, everybody, to the opening playbook for Monday, February 23rd. We are rocking and rolling here, and we have a new form that we welcome everyone to fill out if they haven't filled it out already. But it's particularly for new visitors. You can see we have a link up at the top, and I dropped it in the chat. We'll talk a little bit more about that in a few minutes. But we have with us the one and only Nathan Tucci. Hello, sir.
Hello, everyone. Happy Monday. Hope everyone is doing well this Monday. Um, had a wild weekend. If anyone watched the United States Canada game, it was some good stuff. So
Yeah, awesome
still,
matchup.
I'm still living off the high of that, but it was
Yep.
good. Did everyone get to attend the pre-show today with David and get to go through especially our new folks here, get to kind of go through the beginner's update and grab that free little worksheet that we have for you. Hopefully that'll be helpful for those of you following along, just to kind of make more sense of the terminology that we use and things like that. All right, let me make sure my notes are in the right spot here. Good morning. Good morning. And then I will start off just taking a quick look at where we are. We've already bounced around quite a bit, actually, today, back and forth a few times already, but let's just do a quick highlight.
Nate, it's been just such an annoying market. This morning when we filled the gap right away, I'm like, oh boy, here we go.
Yeah.
Back down about 0.5%.
Yep. Back and forth we go. Here's where we stand. I'll just walk you guys through the current market real quick before we get into today's lesson. So as Graham said, shot back up, filled the gap, looked like we were going to kind of buy all the way through the open, then it shot back down. We're seeing the same kind of leaders here, with small caps being the weakest and mags fairly weak as well. Of course, Bitcoin took that big shoot straight down last night. I shared that on Telegram. Really got going to the downside, but gold and silver went the other direction, had a good pop up. Here's where our sectors open today. Again, more our risk on sectors for the most part, pretty much moving down. Industrials actually moving down as well a little bit. And recently, industrials have kind of been more of a win-win. They've been green most days, whether the broad market is up or down. Getting a little bit of a pullback so far. And then financials continue to be really weak. I mean, I tried to buy the dip once on financials and they moved a little bit lower. I'll probably try again if we get to another level there. So interesting to see how weak financials have been. Discretionary, obviously, very, very weak today as well. And here is our heat map of the top 100. Interestingly, and this is from about 15 minutes ago, so it's a little bit more red now, but generally it's about 50-50. We are seeing all these healthcare names pop up and look pretty good. We're seeing some energy names as well that have moved, into the green. And then we're seeing a mix of stuff in the middle, from technology to staples to industrials, stuff in the middle. And then at the very bottom here, we've got Palantir, just can't catch a break, just been getting pummeled. Microsoft, kind of the same. Intuit, a couple other ones, just really looking rough to the downside. So, and again, some of these big financial names that look like they might actually pop up and give us some life, not looking so good right now. So we'll see what we get the rest of the day. I personally think this first half hour of the market that we've experienced so far is probably not going to matter a whole lot, just because we are in the chop and the chaos right now. I'd like to see things actually get settled down here and kind of see where we end up. So let me get my little presentation. So I'm going to talk about the R word today, risk.
Oh,
Um,
Could have gone a dramatically different way there.
yeah. We're talking about risk today. It's a topic that I feel like not everyone wants to talk about, but I think it's incredibly important. And I also think we tend to have a bad understanding of it, and maybe even more so than a bad understanding. We just use bad terminology sometimes. By the way, including me. Just by default, we kind of use some bad terminology when we think about risk, and so I want to walk through that and hopefully give you guys what I think is a little better framework for thinking about risk in your trades and how to assess it in more of a systematic approach, for lack of a better word. So, Graham, before I dive into that, anything on your plate?
The only thing is two things. SanDisk is looking good. I'm not going to post a screenshot in Telegram because the last time I did it marked the top and then I went underwater after that. But SanDisk is looking really, really good again. Should be up nice on that if you guys took that. And Lilly, did you see Lilly had a nice little pop today? They've got a new weight loss drug that could spark another move in Lilly. So just keep an eye on Lilly. That's all.
Nice, nice. Yeah, I saw that they got a little life there on that pop. So that was one we talked about when it was really beaten down as a asymmetric opportunity. I actually took NVO because it was beat down worse, and I thought, hey, I'll take the one that's beat down worse. Well, turned out it never got the life back that that Eli Lilly has, marching back up and making an incredible recovery. All right, I just realized that I have a math mistake here in my notes, which is, we don't want that because we're going to talk about math. I don't want to
That
lead
would
you
be
guys
embarrassing
astray.
with Bram here.
I know.
He would make you suffer for that.
There might actually be another one in there. I didn't actually triple check that, but I'll let the people in the chat. I'll just, what do they call that? An Easter egg. It'll be an Easter egg for the people in the chat to call me out if it's wrong. All right. Let's get rolling. With the reality of risk. All right. Again, not a topic that everyone loves discussing, but I think it's a good one. And so my first question for you is, if I just ask generally for you guys to think about a risky trade right now, what is the first thing that pops your mind? If I say, what's a risky trade? I think most people maybe would say an earnings play, like a lotto ticket trade that, we would put here with a way outsized debit spread, or just an out of the money option or something like that. And anything else, let me know in the chat. Just, kind of the first thing that comes to your mind when you think of a risky trade. And we will, we'll circle back to that here in a moment. But just let me know in the chat what kind of pops your mind when someone says risky trade. Okay, we're going to talk about what risk reward actually is, the illusion of high risk trades, thinking in expectancy, drawdown survival, and putting it all together. That is on our list today. So first, let's start with the basics. What is risk to reward? Well, it's the ratio between what you can lose and what you can gain on any given trade. So if you risk $200 or $100 to potentially make 200, that's a 1-to-2 risk reward, 2 times the reward as your risk. If you risk 200 to make 100, so that's the opposite, that's a 2-to-1 risk reward. Pretty simple, right? That is what a standard risk reward is. Now, a big part of our job as traders is to express our opinion in the structure that makes the most sense. Because the same opinion, think, for example, that I'm short-term bullish on any given stock, can be expressed on the same stock with completely different risk profiles. So, for example, you could buy 100 shares of this imaginary stock at $150. You deploy 15 grand. Your max risk would technically be the 15 grand. Your reward would technically be unlimited, but you would expect to make slower returns. If the stock dropped 10%, you're down 1,500. If the stock dropped, off a cliff 30%, you would be down 4,500. But of course, that's what most people think of as a safe trade, buying the stock. And this is kind of what the risk profile looks like. You're pretty linear, right? There's no time decay here, nothing that's going to make it leveraged or out of control. So if the stock goes up, linear upside. If the stock goes down, linear downside. Structure number 2 would be buying a call. So again, think of it as the same stock, but now you're going to buy a call option. Maybe you pay $500 for that call option. You're deploying that $500. Your max risk is also that $500. And then the reward is the leveraged upside. Now, the catch of that is that even though it's lower risk, you have time decay working against you every single day in a regular call option. The risk profile is more like this, right? So once it gets above break even and it keeps going in your direction, it can really get going upside to the upside. And once it gets down $500, your risk just flattens out. You can't really lose more than $500. And so your net risk reward can be very positive because this line can keep going up and up and up here, but this line can really only go down to $500. And then it's going to be maxed out because that's the most you can lose. Or we could express the same opinion in a debit spread. Okay, now we're buying and selling an option at the same time. That's a debit spread. You pay $150 for a $5 wide spread. In this case, you're deploying $150 of capital. That becomes your max risk, but your max reward is capped here. It's $350 because that's the other side of that spread. Now, time decay is offset because you're selling an option, but you still need the stock to make a directional move in your favor for something like this for an outsized gain. And here, our risk profile is like this, right? So it can go up, it can gain value, it can get to a max of 350, but then it's capped. Even if we keep going up, value is going to stop going up. And at the same time, it can go down, and then it's going to be capped at $150. And even if the stock goes down 30%, we don't care. We can only lose our original debit. So same opinion, 3 different structures, 3 different capitals, 3 different risk profiles, 3 different risk rewards. All of that changes based on the structure that we choose, which is why we always talk about how important it is to understand trade structure, because that's what's going to determine all of the components like risk reward that matter so much over time. Now, if you know the opinion you want to express and you understand the trade structures available, 2 great things can happen. Number 1, you actually understand your risk reward. You actually know it instead of following blindly or hoping that it makes sense. And then number 2, you can make a decision based on the most advantageous structure for that particular scenario. So again, just to kind of hammer this point home, if you understand different trade structures, you can look at a scenario and say, okay, here's what would happen if I did a debit spread. Here's what would happen if I bought a call. What if I just bought shares? What if I did it as a condor? You can actually think about all of the different ways to express one opinion and then make the decision on which one you think is the most advantageous. But you have to understand trade structure to do that. So that's the first thing. Step 1, understanding risk reward and understanding trade structures and how they impact risk reward is kind of the first phase of tackling this, this whole risk subject. But one thing I want to talk about is the illusion of high risk trades, which we kind of opened with the beginning, thinking about, okay, what is a high risk trade? And this is something that pretty much all of us do instinctively. You think of something like an earnings trade, you say, okay, well, this is a risky trade. I mean, I say that all the time. Hey, keep in mind, guys, this is a high risk trade. You probably do the same thing. And it's always kind of instinctively something that feels like a lotto or a gamble. The problem is that's actually very bad terminology that we've all gotten used to, and it probably damages our real understanding of risk. So my apologies, because I totally do this all the time. And from a terminology standpoint, it's actually very inaccurate and it's unhelpful. But it's just, again, kind of instinctive when you think of risk. Really, there are 2 very different things happening here. What we say when we say risky is, oh, this trade's probably not going to work out. We're probably not going to make money on this one. The odds are against you. That's really what we're saying. But what risk actually means is not that. What risk actually means is this trade costs a lot. There's actually a lot more dollars at stake here. I can lose a lot more money. It's really about exposure and how much you can lose. That's the true definition of risk, and not that it's a gamble or that it has a low probability. So low probability does not equal high risk. I think, again, very easy to talk about it in those terms, but if we actually want to think about risk appropriately and use risk reward appropriately, then we have to understand that low probability is not the same as high risk. In fact, they're usually correlated in the opposite direction, which we'll talk about in a second. But two different dimensions, and conflating them can lead to bad decision making. An example would be Graham's lotto board. So we think of lotto plays as inherently risky. Now, the irony is those are some of the least risky trades that we can take, because we can take one of Graham's lotto trades and risk $35 or $50 in our account and try to make $200 or $500 or $1,000 when we're right. So something aggressively out of the money might feel risky, but what we're really saying is that we don't feel as confident that we can win. That's kind of our default for high risk. By definition, these are low risk trades, and they probably do fit into our portfolio quite well, in addition to something like high probability income trades. So the point here being, I'm not saying that you need to trade lotto trades. What I'm saying is, if you have a bad understanding of it and you think, well, I don't really want to add high risk trades to my portfolio, well, you're kind of starting off on an incorrect foundation, and then you might make a bad decision about what actually would be a good, texture for your portfolio. Again, that doesn't mean that every one of you needs to trade that way. It's just a kind of a concept of actually different things have different risk profiles, and a mix of them is probably the best way to manage your portfolio. So, for example, we can compare a $78 lotto play targeting 500 to what most people would consider the safest trade out there. Buy 100 shares of a blue chip stock at $200 per share. Well, the issue is you just deployed $20,000, and a normal 5% pullback is going to cost you $1,000. A 15% is going to cost you $3,000, and there's really no cap to where it can go. Now, you might say, well, yeah, but in that situation, I'm not going to close it. I'm not actually going to lose the $1,000. Well, okay, but then you have to ask yourself, what if in 10 years the stock's still down 30%? Like what? There's still a risk. There's still a pay the piper at the end of that trade that has to be considered. And so the real question is, what trade is actually riskier in the truest sense of the word? Buying 100 shares of the safest blue chip stock you can think of, or taking a $78 lotto play? Well, the trade everyone calls risky has $78 of actual risk, and the trade everyone calls safe has $20,000 of actual risk. Okay, and so that's the thing that I think we can so easily get wrong. And it's not just that, oh yeah, oops, we said the wrong word. It's that you don't really want to let that filter into how you think about trading, because then that can lead to what I think are other downstream effects that are negative if you have it kind of let that default bad understanding of risk permeate the way that you think about overall trading. Does that mean that we should always take super aggressive lotto style trades because, hey, those are really good? Wow, those are actually low risk and they can make a ton of money. So should we always take those kind of trades? Well, hint, the answer is no. That does not mean that those are the best trades, certainly not the only trades. It's just an understanding of a different dynamic. Because risk is one-dimensional, and so is probability. They're both one-dimensional components of a trade. Neither one of them tell us if an opportunity makes sense on its own. Okay, so neither probability or risk alone are going to tell us anything. We have kind of different dimensions here. You might have high probability and lower risk. That might be like a wrap order, can be pretty low risk, pretty decent probability, pretty decent reward. So that might be something that you kind of consider up here. Maybe it's an income machine trade. It's pretty defined, pretty high probability. Okay, you're not going to have to risk thousands of dollars. Then you have lower probability, but also lower risk. Lotto play, right? Low probability, but it's only going to cost you $38 to go after a big potential win. What about high probability, but also high risk? Well, that would be like a naked put, right? So you're gonna sell a naked put. It's going to be a really high probability, but you could also get assigned $500,000 in stock. Well, now that's a lot of risk, but it's also very high probability. And then you could have high risk and low probability, which this is the quadrant I would avoid. This one I would typically avoid, but for some accounts it makes sense. The bottom right is the one I would typically avoid. That's like, I'm going to go out and buy a super expensive option that doesn't even have high probability, but it also adds a ton of risk. And that combination, I think, is probably your worst case scenario for most retail traders. But all of these actually do work independently and differently, just depending on the circumstances of the trade, which again goes back to just understanding structure and why it matters and how to apply it. So probability and risk are correlated, but they're still independent. Usually a trade that has more risk will have higher probability, like selling naked options. It wins often, but when it loses, it can blow you up. Usually a trade that has less risk will have lower probability, like a cheap out of the money option, low risk, cheap. It loses often, but when it's losing, it's small, right? It's not going to tank your account. Most traders kind of mentally collapse those two dimensions into one. They just treat everything with low win as risky and everything with high win rate as safe. That kind of tends to be the default. Now, some people are backwards. They kind of do the opposite. They think everything with a negative risk reward is horrible and only things with a positive risk reward make sense. And we'll talk about a couple examples of each. But the default for most people is, hey, an earnings play or an out of the money option is risky. And, something like a covered call is always safe. Now, what really happens, and where I think, again, trading gets dangerous for most people, is that they gravitate toward what they feel safe, what they feel like makes sense. For some, that might mean lower dollar risk. For others, high win rate makes them feel safe. For others, complexity feels risky, so simple feels the safest. The problem is that none of those are independently a metric of positive expectancy, which is really the only thing that's actually going to matter today or over time for a strategy, right? So none of the things that we kind of gravitate toward are going to actually determine if it's a good strategy. But, all of us kind of have that instinct of what we like or what makes the most sense or what clicks in our brains. So if probability alone doesn't define risk, and risk alone doesn't tell you if a trade is worth taking, what do we do? Well, what I would advise that we do is that we try to think in terms of expectancy. This is something you'll hear Kane and I talking about quite a bit, how to, think in terms of expectancy, even in a trade that is discretionary in the moment, kind of map it out. Well, all expectancy really is the metric that combines probability and risk rewarded in one number. That's really all it's doing. It tells you on average, how much do I make or lose per trade over a large enough sample to validate this trading strategy. If you've ever played poker, you would understand this concept. Most people call it pot odds, right? So it's like, hey, if I'm on a flush draw and I have a 40% chance of hitting a flush and I'm heads up, that means one-on-one, then I shouldn't make that bet, right? Because I have a 40% chance for doubling my money. But if there's 4 people in the hand, now I have a 40% chance to make a 300% return. We call that pot odds. It basically says, hey, it's not just about whether you expect to win the hand or not. It's actually about how much money is in the pot relative to the odds of you winning the hand. That's what really matters. Okay? For those of you who don't play poker, here's the formula. Win rate times average win. It's in parentheses. That means do that separately. Loss rate times average loss. Do that separately. And subtract one from the other. That's going to give you your expected return per trade. Now, if that number is positive, it means you make money over time. If it's negative, that's going to mean that you lose money over time. 0 would be break even. And this is really the only number that's going to tell you if a strategy actually works. I shouldn't say the only number, because you could put that in different formats, but it's the core number to think about that's going to tell you if it's positive or negative. It's the baseline number. So again, positive expectancy makes money over time, negative loses money, 0 breaks even. If you know that number, you pretty much know whether you're going to be trading with an edge or not. Okay, here's the example we always give. Imagine a coin flip game, right? If heads you win $2 and tails you lose $1, that's a really good game. You're going to play that game as much as you can, because 50% of the time you're going to make $2. You multiply that together, your expected win is $1. How did we get a $1 expected? Well, we just multiplied 2 times 0.5. That equals $1. Your expected loss, just multiply 1 by 0.5, 50 cents. Your expectancy is 50 cents per flip, right? Positive expectancy right off the gate, just knowing those few numbers. Now, with coin flips, it's easy because we happen to know the win rate already. Not everything you already know the win rate going in, but with a coin flip, we do. So now let's try to apply this to trading with a couple of different scenarios. So some of you in the room love win rate, and that's what feels good to you. Give me a yes in the chat if you know that you kind of gravitate towards win rate as the thing that makes you feel good about any particular strategy or trade structure. A lot of us, I would say I'm more in this camp. I think I've blended out over time, but I'm more in the win rate camp. Yeah, okay. A lot of you guys are in the win rate camp. All right, well, let's give you an extreme example where the win rate won't work, and then one where it will work. Okay, so you could have a strategy that has an extraordinarily low win rate. Again, I'm giving extreme examples here to make the point, obviously, where it wins just 10% of the time. But when you win 12 times your money. When you lose the entire option. So just doing the math, on a $100 trade, the 10% chance is going to make $1,200. The 90% chance is going to lose $100. Well, over time, you're going to average 9 losses minus 900, 1 win in that set, net $300 or $30 per trade. Okay. Does everyone see how we got the $30 per trade from these numbers? We took a series of trades. You don't have to do it with a series of trades. You could just do 1 times the percentage, but it's easy sometimes to see it in a series of trades. We took 9 because there's 9 losers and multiplied it by the amount. That's 900. Then we took the 1 winner, got that amount. That's the 1,200. 1,200 minus 900 gives us our net profitability of $300. And it took us 10 trades to make that $300. So we get to an expectancy of $30 per trade. Okay, so that's the ugly but profitable. Again, there's that math for you. Okay. Then we have the high win rate, but a terrible payoff, right? You win 80% of the time. When you win, you only make 15%. When you lose the full amount. So in this case, on the $100 trade, you have an 80% chance of making $15. You have a 20% chance of losing $100. Okay, same thing. You're going to go across those trades, 8 times 15, 120 in wins. The 2 lose 100. That's $200 in losses. You get your net expectancy of negative $80 per 10 trades or negative $8 per trade. So again, for a lot of people that look safe, 8 out of 10, but it's just bleeding money over time. All right. And then here's kind of the equity curve that's going to tell you the real story over even more time. They're both pretty ugly, but this one is going to go up. If those numbers hold up over time, this one's going to go up, even though it's looking pretty ugly on its way. So again, this one feels bad and makes money for the people who like win rate, but the one that feels good loses money for the people who like win rate. Now, some of you are on the opposite end of the spectrum. You love risk reward. Give me a yes in the chat if that's you. Anything that has a positive risk reward feels much better to you. I'm always going to make more than I risk when I'm right. All of you in the chat who are risk reward folks, give me a yes in the chat. This is a whole different group of folks, and they always feel better when the wins look bigger than the losses. All right, so let's go through, again, just to draw the point here. Opposite example, a home run strategy that doesn't win enough. So say you win 5% of the time, you make 800%. I mean, you could still make 1,200%, but just to make the example extreme, it would look something like this, right? Lose, 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 lose. You finally win one, but it's just simply not enough. And so your expectancy is negative per trade. Or an income strategy that actually works, right? A win rate of 75%. When you win, it's 40%. You still take your full loss. So on $100 per trade, 75% chance of making $40, or you have a 25% chance of losing $100. And when you stack those numbers up, you get 15 wins over the course of 20 trades, $600. You get 5 losses times 100 per loss, negative 500. And so you have a small expectancy at $5 per trade. So again, the losses feel painful, right? Because you're win, 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 boom, wipe out a whole bunch of your wins, win, 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 wipe out a whole bunch of your wins. But if you maintain these numbers, you're net positive over time. All right. And so again, just the math there, pretty simple, same as those bars. Wow, my spelling's not very good today. All right. So why do our brains kind of have a hard time with different scenarios and gravitating? Well, number one, we all just have different wiring. We all like different things. Number two, we probably have been trained on different concepts. We probably all went to a really good seminar where someone talked about positive risk reward, or a really good seminar where someone said, the Harvard Business School suggested that a higher win rate strategy has lower drawdown over time because the mathematical streak over the same 500 trades is better on 2 equivalent strategies with an 80% win and 20% average win compared to a 20% win rate and 80% average win. And so therefore, win rate matters. So that could be part of it. In general, we tend to just feel better and click with something clicks with us for most people. Now, some of you may not. Like Sean said, I want high win rate and high reward. Yeah, that would click for all of us. Unfortunately, there is that correlation, so we can't quite get that magical strategy all the time. But for most of us, we kind of gravitate, and one thing makes sense to us. Now, there's nothing wrong with that objectively, as long as you are still grading the trade on an objective basis. All right. So there's nothing wrong with kind of leaning in one direction or another, as long as you can actually grade the strategy objectively in whatever direction you're leaning. Now, this is in part why I like systematic approaches so much, because I don't really want to let myself gravitate toward what feels right. I just want the math to say, hey, this is right, this is wrong, this is how the numbers shake out. I'm going to feel a lot better about that than kind of saying, hey, this feels right in the moment. Now, when I take discretionary trades, I have to kind of do that, put myself in a box. Okay, what do I think the percentage chances of this are? What is the risk reward? Is that a positive expectancy? Yes or no? How positive? How much do I want to risk? You have to go through all of that when you are thinking about a one-off trade, because a one-off trade is not going to have a systematic, back-tested, forward-tested baseline, but a series of one-off trades can still have a net advantage. So expectancy is the only number that tells you if a trading strategy actually makes money over time. Just to be very clear, win rate alone can't tell you that. Risk reward alone can't tell you that. You have to combine them together. But, and this is a big but, before you decide to risk heaviest on the most positive expectancy strategies, we do need to throw another wrench in the mix. Because most people would probably say, all right, Well, maybe I'm trading 4 strategies. They're all positive. Well, at least I hope they're all positive. But this one has a really good expectancy. This one has, a medium expectancy, whatever. So the way I'm going to handle my risk in my account is I'm going to risk 5% on the highest expectancy strategy, 3% on the next, and then 1% on the lower expectancy, but they still trade enough that they're worthwhile and all that. Well, before you do that, there's a little bit of a wrench you have to throw, which is expectancy plus drawdown. So expectancy is everything in terms of knowing whether a strategy is positive, but it's not everything in terms of knowing how much you should risk per trade. So let's say you found a strategy with a positive expectancy. Great, step 1. But again, expectancy is an average, right? It's what happens over hundreds of trades. Expectancy is not what happens on every trade. It's what happens over a series of trades. And the individual trade is binary. You're either going to win or lose that. And in the short term, you can hit losing streaks that make you question everything. How many of you have been there, right? You still feel like, I know it works, but wow, I'm not sure if I can handle this much longer, right? I like this line is really important. I like what Kane says. He says you can only express an edge in trading over a series of trades. You can never express an edge in trading over one trade. It's impossible, right? You need the series of trades. And so you have to remember that when it comes to managing your risk. Most traders don't blow up an account on a single bad trade. I mean, some do, but most don't. Most have a sequence of trades that hits their breaking point and then they give up. Let's think about the same strategy, but with different sizing. So take a 10% win rate with $30 of expectancy per trade. That's good, positive expectancy. If you risk 2% of your account and you hit 10 losers in a row, your drawdown's about 18%. Now that's manageable for most aggressive traders, right? If you have an 18% drawdown, most people can handle that. If you risk 10% per trade on those same 10 losses, now you have a 65% drawdown and your account is essentially crippled because you're going to have to make 130% return to get back to just where you started. So it's still the same strategy. It's still a positive expectancy, but you have completely different outcomes just based on how much you risk per trade. Okay. And you can think about it like this. Here is what happens on 10 consecutive losses based on different amounts. 1%, 2%, 5%, 10%, 20%, right? So if your strategy has the potential to have a 10 trade losing streak and you're risking 5% per trade, but you can only handle a 10% drawdown, well, you've got a problem because you are likely at some point to take a 40% drawdown. And if you're thinking, hey, more than 10% drawdown, I'm out of the game, and you're trading a strategy that is likely to take a 40% drawdown, obviously you're going to have to look in the mirror and say something needs to give here, right? So understanding your potential drawdown is just as important as trading with a positive risk reward, or a positive expectancy, because you actually have to apply risk management to that positive expectancy. So there is actually a term for this. It's called the Kelly criterion. I'm sure some of you guys have heard of this if you've been trading for a while. It basically, what this tries to figure out is what is the mathematically optimal bet size for any given scenario. Okay. Basically, it's saying, okay, if the positive expectancy is really high, but it goes on these losing streaks, if I take so deep of a drawdown that now I'm using large chunks of my best win rates just to get back to break even, I'm actually not taking advantage of the strategy. So I have to risk less to lower that drawdown. At the same time, if I risk so little that I'm not taking advantage of compounding the account with the positive risk reward strategy, then I'm risking too little and I need to increase my risk, right? It's called the Kelly criterion. You can look it up. If you know the basic metrics of your strategy, you can actually plug it in and basically it'll tell you, hey, assuming within the criteria that you're comfortable with, This is about the right risk to get the optimal result. Now, that means optimal in terms of, curve, in terms of growth. It doesn't mean optimal for your preferences. So you still have to account for that. Now, the truth is, the average optimal risk is probably lower than what you think, even on a really good strategy. And again, it's just because of the streakiness of any statistical likelihood over time. So here is the mathematical likely likely streaks, likelihood of taking streaks.
Streakiness.
Streakiness, the mathematical streakiness. If you have an 80% win rate, generally speaking, your max losing streak over 100 trades, 4 to 6. If you have a 70%, 5 to 8. If you have a 50% win rate, 8 to 12, 30%, 12 to 18, 10%, 30, even to 50 plus. And then if you stretch that out, which Kane has a formula for that, and you say, okay, what if you do 100 trades per year over 10 years? Then what's my likely max? Well, it's going to go up. It's not going to go up exponentially. It's not your 80% win rate strategy isn't going to go up to 60 losing trades in a row, but it is going to go up. Okay. And so you have to obviously know that going in, right? Again, if you want to plan for risk, you have to plan for the worst case scenario. That's the nature of risk. If you can't trade a strategy through its worst case scenario, then you can't trade it at all. So here's a way to think about it. Before you trade any strategy, think about this. What's the longest losing streak I should expect? Use the table. Just gives you a good baseline. What's my max personally acceptable drawdown? For most people, this is probably 20 to 30%. The reason for most people it is 20 to 30% is because the underlying market is probably going to draw down 20 to 30% over the course of a decade. And so most people who are active trading, they can handle a 20 to 30% drawdown. They don't like it, but it's essentially going to mirror what their worst case just buying and holding would be. And so that number tends to be about right for most people, but yours might be more or less. The way that I do it is I have a very aggressive active trading account that I put separately in and I risk more. And so for me, I don't even mind a little bit deeper drawdown. Then you can work backwards from that number to determine your position sizing. Okay, so if I can stomach a 25% drawdown and I'm expecting that at some point I'm going to lose eight trades in a row, well, I know for that particular strategy, I can risk about 3% per trade. Now, that's, of course, on an individual strategy. You're probably going to have other trades and other strategies going on that then you're going to have to be, a little more dynamic and nuanced in your math. But for one strategy, that's what you would do. Now, here's the thing that you really can't calculate. I mean, maybe you could calculate it, but it's pretty hard to calculate, which is the risk of you or me abandoning the system, right? So if you're convinced that the 10% win rate strategy is going to work with that plus $30 expectancy, you also have to realize it only works if you can take trade number 47 after losing, 38 out of 46, right? Because that trade is what flips it back to the positive expectancy. And the truth is, most people can't do that. But if you size properly and you understand, exactly what you should expect, well, then maybe you can handle it. Maybe you can say, listen, this is exactly what I expected. I'm doing this with a very low amount of risk. Whatever your scenario is, you are going to have to account for this. Because this is the part that I feel like no one likes to talk about out loud, which is that most strategies, the biggest risk is this. It's like that quote I gave you about the Magellan Fund, that even though it's the best fund in the world, most retail traders still lost money in it because they jumped in when everything was going great and they were missing out. Inevitably, that's right around the time they would have some drawdown. Then they would bail out and lose money. And they'd look back over 20 years and say, I actually lost money on the highest performing fund in the world. And that's because of this. It's a psychological game at the end of the day. And so if you can't address that part head on, what am I willing to risk? What am I expecting on losing streak? What is that going to look like in my personal account? And can I handle it? You're probably going to have trouble trading any strategy. So the two questions before every trade, and by the way, every series of trades, would be, is the expectancy positive? And can I survive the worst case sequence? You know, the worst case expected sequence. We don't know the worst case true sequence, but the worst case mathematically expected sequence. And you just have to be honest with yourself, guys. If you cannot handle the worst case expected sequence, you should never start trading the strategy to begin with. Then you're turning something that is meant to be a mathematical edge into a different version of gambling that you're not going to hit that worst case scenario sometime early in the sequence of trades. That's just a different type of gamble, and it's not one that you should take. All right, so trying to put this all together. The old way of thinking about risk, gut feeling, high win rate tends to feel safe. Position sizing is based on conviction. Obviously, in general, that's going to be inconsistent, emotional, prone to blowups. Hopefully, if you guys can get a hold of this and think about it with more of an expectancy framework, you start thinking of, is this trade worth it? Does the risk to the potential relative to the win rate make sense for me to put this trade on? Okay, so expectancy determines if it works. Drawdown determines sizing. Risk is defined before the entry. Okay, you kind of know going in what's the worst case, and am I willing to endure that? So here's just kind of the quick checkpoint that you can use. What's my max loss in dollars? What's my estimated win rate? What's my target return if I'm correct? What then is that expectancy? Just literally do the math. What percentage of my account is this trade? Can I survive my worst likely losing streak? Yes or no? Just if you can go through that checklist and not freak out by the time you get to question 6, well, you're probably in decent shape, right? Now, one more thing, and I am wrapping up here. One more thing. Don't forget about time. Okay, because lots of different variables here. We did things assuming this one is equal, all things being equal on the time front. But you do have to think about time. The longer you're in a trade, the longer that capital can't be deployed somewhere else, which is opportunity cost, and it is a real form of risk. Okay? And this is one of the reasons that I like those defined time frame strategies, right? I know my max hold time on overnight options or automated options or even income machine, even though it can be different, I still know going in the max time. It's clean, it's defined, and then I can compare that with expectancy as well. Because keep in mind, a slight expectancy advantage that can be used every day is better than a very big expectancy that can be used once a year, right? So if I have a strategy that nets out at a $20 per trade advantage that I can take 200 times a year per contract, well, now that's $4,000 a year of positive expectancy per contract. But if I have a strategy that's 10 times better, $200 in expectancy, but I can take it once a year, well, it's not nearly as good as the strategy that's, 1/10 as good, but I can multiply 200 times over. So you have to think of it in terms of time, both in capital allocation, but then also in how many times can you multiply? How much can you recycle the same dollars in your account to take advantage of that expectancy? And so we could look at a trade and kind of map out different scenarios to put this in more of a practical nature if you guys want. Let me know if there's a stock you like or something that we could look at specifically that's interesting to you. But also, let me know if you have any other questions, and I will be happy to answer those because I do think this topic is one that we don't probably cover enough. The R word, as I say, not one that everyone likes to bring up right off the bat. We like to talk about gains. We like to talk about the potential, but obviously risk is going to play a huge, huge, huge role in the overall course of things. Okay, NVIDIA. We can look at NVIDIA is right at the top of this range right now, so it's not my favorite, but we can take a look at it. How did NEM do on earnings? I never actually came back and looked. Looks like pretty mild. Pop down, pop back up, nothing too much there. NEM is also, I'll show it to you, also kind of squeezing right now. Oops. This is the NEM daily chart, and you can kind of see it's just kind of chunking along. Looks like it'll probably break out, but we're right at this gap fill churning out zone. Again, NVIDIA, I'm not a big fan of right now, just because it's also in this this range. It had this breakout initially and then came right back and has had 3 chances to crack above 194. Hasn't been able to pull it off. So, I mean, you could trade it back to the downside, but I'm not sure I'm bearish enough to trade it to the downside. So I'm more just waiting to see if we can get something confirmed to the upside. Mike says Microsoft. Whoo, wow. That is ugly. Microsoft did fill the gap and kind of has more of a break and go look to it right now. So Microsoft, we could probably trade all the way down. Can't believe I'm saying this number, all the way down to 350 on Microsoft. Now, maybe we don't want to take this trade, but we could still look at it as a good example. Because what we could say is, okay, in general, and let's go to 30, well, let's go to 26 trading days, about a month there. 22 trading days, sorry, about a month there. And let's just look at the ATR. So over time, Microsoft is a pretty big mover. It's moving about 7%. So at 386, a $30 move, we're actually not far off from that being about right over a month. We'd obviously want to give that some extra time. So hold on. Let me move my Thinkorswim over here. Oh, wow. SPY down almost a full percent again today. Jeez. I'm sure Microsoft's not helping it. Here, let me pull up Microsoft, and then we can actually look at this as a comparison. Get this out of the way here. Okay. So if we wanted to give Microsoft 7 or 8 weeks, which is about right for that big of a move, even though it's moving much faster than that now, we'd still want to give it the time. We could start to look at what those scenarios would be. If we bought the 355 put, for example, we could risk about $600 per contract. $600 per contract. What we would need is to get the timing and direction right all the way down to about 350. Probably is, a 25% chance of being right, maybe a 20% chance of being right. But at that point, it's going to be $30 in the money. It's going to, wow, I'm confusing people. It's going to be about $5 in the money if it moves all the way down. And so you can kind of compare that to what the puts are trading that already are in the money, about $17 or so. So a couple 100% ROI. I would say not a super attractive expectancy for that $600 of risk, but if you have a higher confidence than say 20 or 25%, that trade might start to make sense. Compare that to the vertical, and we could actually look at the 355, 360, and now it gets a little more interesting. Because if we're right, and it gets down to 350, now we're talking about more of a 400% return at about $1 on the debit spread. So that one becomes pretty interesting. If Microsoft does get down below 350 over the next, that would be 7.5 weeks. Again, it's moving a lot faster than that, but I'm kind of going based on the standard move because Microsoft does have these sideways channels often between breakouts. So I always like to use the actual net ATR. So you can kind of see this trade with 1/6 the risk and what I would think of as a better risk to reward, because what I would assume is that if Microsoft does come down, this is about the base. I wouldn't expect it to hit, 300, for example, where that put really starts to generate a ton of profit. Now, what you could also do is you could look at other structures. You could say, for example, okay, what if I don't want to be that aggressive? I just think it's going to go down some. So I'm going to trade this 380, 385. I can still make 130 to 140%, but in my opinion, this brings the odds from 25% to 60%. Well, now you can just run the numbers and say, okay, well, 150% at 60% odds versus 25% at 400% odds, this trade is better. And you can say that objectively, at least based on your expectation. Now, you do still have to do it based on your expectation because we don't have a magic formula that tells us the probability of Amazon going to that level, but you can start to think of it in terms of expectancy. So this is a trade that I would actually feel pretty good about, that Amazon Microsoft rather at least gets down to this level, but I would probably want to give it a little less time for that smaller move and see if I can still get that good value. So let me see, probably the March 20th. And I can, if not even maybe a little bit better value. So what I would say is, okay, I think Microsoft looks really bearish. It has the potential for sure to collapse all the way to 350, but I'm not getting 5x or 6x the return of it going to 350 as I am just going to 380. I'm only getting a couple times the return. And so when I manage those numbers together, this trade that feels significantly more probable to me. I mean, look where we are now. This trade feels significantly more probable to me and still has a very positive risk reward. I like it better. And again, you could compare that to, okay, let me take the March 20th and just buy the 380 put. Well, now I'm risking $1,000 instead of $200. And if it does only get, let's say, to 378, 379, I'm actually not even making any money yet on that trade. Okay. So the probability to risk reward feels far worse in this case on the single option compared to the vertical. You could also do this as to make it even cheaper, by the way. Make this trade even cheaper and do the $2.50 one. All right. So if you like that trade, I'll take it. This is just put a couple $100 on this one. I think it's actually a pretty decent trade. I'm going to risk a whopping $200 on it because I am kind of doing it off the cuff here. But I don't have enough shorts in my portfolio, I'm sure, right now for how choppy this market has been. So you could take a trade just like that by comparing what is my worst case scenario? Okay, $200. What's my best case scenario? $300, 150% ROI. Do I think this has a better than 50-50 chance of getting there? I would say yes. Well, now that's a positive expectancy trade that you created not based on a gut feeling or, some hot tip or headline that you saw and you reacted to, but based on actually thinking through the numbers. And I think if you guys can do that and get in the habit of doing that and then really start to build your whole kind of portfolio approach that way, like we talked about with win streaks versus losing streaks and all that sort of stuff, now you have a complete risk methodology baked into your account and everything you do. So I hope that's helpful, guys. That's how I try to do all of my trading, even the discretionary off the cuff trading. I try to do, at least with an understanding of what I expect and therefore what my expectancy is. And then, of course, on the systematic side, I'm doing the same thing, but I'm actually running all the numbers to get there. So I hope that's helpful. For those of you who like the idea of, kind of the high win rate, the more defensive trades, obviously I recommend the income machine for that. That's, the same idea. Basically, it's running through the options and trying to say, okay, how do we get a defensive scenario that gives us a big enough cushion for that high win rate? Because it's building a cushion based on how the stock actually moves. How do we get a big enough cushion while still having a good enough risk reward? It's the exact same concept. It's just doing it automatically by looking through the options themselves. So, as I always say, if you guys aren't using the income machine, please use it. I shamelessly plug this all the time. I just think it's the most no-brainer tool to have in your arsenal, whether the markets are going up, whether they're going down, whether they're chopping, and it's just volatile. Every scenario, I personally think, calls for this kind of trading in particular because of all the things that we just talked about today. So if you guys aren't trading with Income Machine, please do. It's free to try. Can't say that about most of my tools, but this one is. And I would love for you guys to be on board. I think we're going to have our next masterclass in the Income Machine next week too. So looking forward to that. And again, hopefully our lesson today was valuable and helpful to you. And I will see you all later on.
All right. And folks who just asked a few questions, stick around. I'll answer them in the chat while we get this going.
So today you guys are going to see the first income tool of its kind. It's designed to give you different choices, different options, all done for you. And that way you can find the one that you find most appealing. And today, by the end of the class, you can unlock the newest income opportunity today. No payment necessary, nothing like that. Like Nate said, no strings attached. Now, the trades expressed today are based on signals that the income machine generated with the benefit of hindsight. And while today's guest, Nate, has been using this tool with great success in his own trades, including a 93.3% win rate as of this last week, with a 4.92 profit factor on live signals. Well, you guys know that that's great, but there's going to be winners, there's going to be losers, so let's be smart here. Now, every example today is based on $2,500 unless otherwise stated. However, this is important. You don't need $2,500 to get started. A lot of these picks are as cheap as $100, $200. Some are even like $50. Now, the stories that we're going to share today were from real people who submitted their story for us to showcase. We did not meet with anyone one-on-one. We did not advise anyone's financial situation. We don't do that. We're publishers, not financial advisors. Now, each person makes their own decision when it comes to trading. So trade at your own risk, and you can see the terms on our homepage for more information.
And by the way, thank you for all those incredible stories you guys sent in.
We ended up with over 1,400. We asked for 500. We got over 1,400. Now, guys, just to say this one more time, there's no black box miracle system. There's going to be winners. There's going to be losers. So be smart. Make sure that you are trading risk appropriately, and then look to grow an account over time.
Sorry, Graham, my keyboard is whacking.
All good. Hi, I'm Graham Lindman, and I'm your host for the big reveal of what we're calling the Income Machine. And today, I want to invite you to get your hands on the Income Machine for free, and I really mean free. It's all part of a brand new initiative designed to help everyday traders target extra income from the stock market. Now, I'm talking about income opportunities that could be worth $250, $500, or $1,000 each week, all based on your own risk appetite and your own investing goals. You see, over the last few weeks, I've been privately meeting with trading superstar Nate Tucci, who is quickly becoming one of the most popular traders under the age of 40. Now, after using his aggressive income approach to publicly grow an account from $10,000 to $50,000 in about 4 months, and then quietly generating over $100,000 in his slow and steady income portfolio last year alone, well, now Nate has set out on a mission unlike anything we've ever done before. It's a mission to solve one problem that no one else in the trading world has. You see, most income methods out there box you into a single approach. They're either built for the ultra-conservative retiree, or they're designed for the risk-hungry investor who's looking to double their money. There's no flexibility, no middle ground, and no way to adjust the opportunity based on your desired approach. or even the ability to shift your risk appetite based on market conditions or other factors. But what if there was an income system that could do more? I'm talking about an income system that could help folks target $250, $500, or even $1,000, depending on what you are most comfortable with. Well, as you'll see today, that's exactly what the income machine was programmed to do. It's the first income tool of its kind, designed to help you dial up or dial down how aggressive you want to be with just a few clicks. Every day, it uses a proprietary formula that scans the entire market, identifies the strongest setups, and then breaks it down into 3 specific trade ideas so that you can choose the route you want to go. The conservative approach, that's for folks wanting to shoot for consistent wins and limited risk, targeting right around 250 per trade. Or the balanced approach for folks wanting to target a little more upside, shooting for around $500 per trade. And then there's the aggressive approach. That's for those chasing $1,000 plus payouts with smart, calculated trade setups. Now, regardless of which approach fits you best, you'll get exactly what you need to act with confidence. You'll get the exact stock and options to trade. You'll get the exact hold time. You'll see the break-even price, the expected income potential, and even the calculated odds of success, all done for you. No guesswork, no noise, just a direct income signal where you have the power to pick the opportunity that you like the best. So whether you're in retirement, scaling up a side hustle, or just getting serious about finding new ways to help build monthly income, well, the income machine lets you pick your path. All you have to do is press go. And today we're going to give you a chance to try it out for free. You won't have to pay a dime, not even a credit card required. That way, by the time this class is over, you'll be able to start using it right away to access the top income opportunities already selected for today, targeting the next $250, $500, or even $1,000 payout right from your standard brokerage account. So Nate, it's great to have you on today. Show us everything.
All right. Well, hey, everyone. It is amazing to be here today, and I can't wait to give you the keys to this all new, fully automated income machine over the next couple minutes. A tool that can allow us to target, $250, $500, $1,000, sometimes even more, using an optimized income opportunity every day with just a couple clicks of the mouse on the tool. It's all thanks to an underlying market phenomenon that I've been using in my top income strategies. Phenomenon that's helped me with, real-time win rates like 77.7% on overnight income, 80.5% on 2A income options. Those are, a great income strategy for people, and even 100% on the weekend income strategy. So obviously, income, this is kind of what I do. These are all on live published trades. But now with the income machine, I've programmed something even more powerful all in one place to help us automatically source some of the best income opportunities each and every week, where you have the power to pick the approach that fits you best. Now, keep in mind, I'm not a financial advisor. I'm not going to go into, what trades you should pick or what you shouldn't go with. That's obviously 100% up to you and what you decide. But I did the best I could to make this tool as easy as possible for anyone and everyone to use, regardless of your preferred trading style or income goals. That includes all sorts of people like Tim C. from New Jersey who wrote in. He said that he is working full time and enjoys hobbies like golf in his free time. So, of course, I like Tim because, that's me. According to Tim, he would like to supplement his income and scale his investment account before he retires. But Tim told us he doesn't want to just blindly swing for the fences. He wants something that's consistent and reliable with a very strong track record. So for anyone out there looking for the most conservative income opportunities, well, we've got you covered. Or how about this one from Tyler G? A lot of folks like Tyler from North Carolina. Tyler wrote in saying that he's a dad who balances a day job with running his own business. And while he might not feel ahead financially, he's very motivated. When he's not working, he's spending quality time with the kids and now looking to grow an account in a way that doesn't steal that time from them. With that in mind, folks like Tyler might not want to stick with the slow and steady approach. They might want something that's more middle ground. So if that's you and you want to shoot for a slightly larger income potential in your trades while still maintaining a really high accuracy rate, well, the income machine can do that too. That's our balanced approach there. But it doesn't stop there, okay? We've heard from people, hundreds of people, maybe even 1,000 people at this point, who are more like Karen from Tucson, okay? So Karen says she wants to target bigger returns and lean into a little more volatility if that means a shot at more money on a given trade. Why? Because she's got a mission. She wants to replace what didn't work. She wants to get into those higher risk-reward opportunities and hopefully fund the travel dreams she's been putting off.
So if you're someone who wants to go for some of the biggest income opportunities available, like targeting $1,000 or more on a given trade, that's why there's also an aggressive income approach baked in, which dials up opportunities that give you the most bang for your buck on a given trade. So 3 different income approaches for 3 different types of investors. And regardless of who you are, which approach might fit you best, the income machine puts you in control. Then it gives you the exact trade criteria to follow along if you like what you see. So over the next few minutes, I'm going to walk you through some of the stories that my students wrote in and show you how powerful this new tool can be for people of all walks of life. And I really mean that. While I do that, I want to start, having you imagine what this tool could do for you in your own life, because you're going to be able to get a chance to use it in just a couple of minutes, because you'll see firsthand how the income machine was specifically designed to help navigate the market for anyone and everyone, regardless of your financial status. So if you fall into the everyone category, then yes, I am talking to you. And finally, as Graham mentioned, I'll be dropping a link in the chat. For those of you already asking, just keep an eye on the chat. That's where you're going to get a link where you can join the income machine today at 0 cost to give it a test run. Now, Wall Street wants you to think that making money from the stock market has to be complicated and time consuming, and that you will have to wait years to get a payout. But the truth is, it only takes a few minutes and a couple clicks of the mouse to start targeting extra cash from the stock market. One of my favorite things is showing folks how to target income from the stock market week after week. It's kind of what I live for. It doesn't matter if you've been trading for 10 plus years like I have, or if you're literally just getting started, you've never put an option trade on. And now with the income machine, those types of opportunities can be more accessible than ever before. To keep things simple, let's say someone has $2,500 to invest and they want to start using the income machine. Well, for starters, we saw tons of stories from people like Linda from Texas. Linda wrote in that she's a full-time side hustler with a dream to retire her husband earlier than expected so her kids can spend more time with her dad. She doesn't want to gamble. She doesn't want to overcomplicate things. She wants something that's stable, something that's steady, something that's going to work with a high hit rate. So let's imagine it's February 10th and someone like Linda pulled up the income machine and wanted to set up with the least amount of risk. Okay, that's what they were looking for. Well, at the top of the list, we would have seen Visa. Okay, that's ticker V, as an ideal income generating stock for that particular week. You can see it right there. Visa automatically pulled up on the income machine. Anyone who wanted the safest play could have clicked on the conservative approach. And with that one click, they would have seen all the trade details. Literally one click, they would have seen all the trade details for Visa on the conservative approach. The ticker to type in, the exact options to trade, the entry price, and even the income potential at expiration that they would get based on the trade. From there, folks could simply place the trade in a standard brokerage account or approved retirement account, and when things worked out, automatically cash out a few weeks later, in this case, with about $302 extra sitting in their account. No guesswork, no babysitting the trade, and with about 60 seconds of quote-unquote work, folks like Linda could be $302 closer to making that dream happen. Next up, we have a ton of students like Kendra C. Kendra mentioned that she's a busy working mom in her mid-30s with a young family. She said she juggles work, school runs, late night dinner, all that stuff that moms do. I can very much appreciate that because my wife is doing that for 7 kids. So time is tight. Lately, she's been thinking about building a second income stream, something that could help cover more travel and new experiences with her husband and the kids, and ultimately less stress in her day-to-day life. Now, Kendra doesn't want wild swings or high risk, but she's also not afraid for going for a little more upside than the conservative approach when the odds are in her favor. So if someone like Kendra logged in the income machine and saw Visa listed as the top income opportunity for the day, they would probably be clicking on that balanced income approach. That's that middle ground one. In seconds, they would have seen the full trade layout, ticker, options, expiration, expected return, clear risk parameters, literally all done for you automatically. All specifically selected to target a slightly larger payout on this Visa setup. And anyone following along could have opened up their brokerage, go ahead and thrown that Visa income position on using that pre-built trade, and then gone back to work knowing that they just gave themselves a chance to pocket a few $100 over the next couple of days. And in this example, by the following Friday, an extra $625 would have hit the account. Now, it's a little juicier than the previous approach using the conservative. For folks like Kendra, a few more trades like that, it could be enough to surprise the family with a weekend getaway. Now, of course, not everyone is looking to target small, steady gains or even moderate gains, right? Some traders want to swing bigger. They're willing to stomach a little more volatility if it means chasing $1,000 plus payout on a single move. Just ask folks like Todd M. He's a soon to be retiree from Central Illinois, and Todd told us that at 64 years old, he's on the verge of retirement, but he's not planning on slowing down. He wants to bail out his funds, secure his grandkids' future, and pay off debt, all while trading full time. And for Todd, he said he prefers to go for those larger returns when placing a trade. So if someone like Todd pulled up the income machine on February 10th, same date, same trade, but this time they could have went with the aggressive income approach. And similar to folks like, Kendra and Linda, the examples we just gave, anyone who went with the aggressive income approach on Visa would have had all the trade details mapped out for them automatically, except these specific options would have been tailored for that bigger income opportunity, allowing folks to target a little bit more bang for the buck on that trade. $1,231, pretty good trade on Visa. So anyone who set the trade signal, when we had Visa on the aggressive approach, could have ended up with $1,231 over the next 11 days or so, giving folks like Todd more time with the grandkids, fishing, camping, and showing them the better side of life without actually having to manage the trade.
Nate, this is awesome, but let me just pause you for a moment here. You just showed us how folks could have pocketed $302, $625, or even $1,231 with a few clicks of the button, all generated, fully automated from the income machine. And honestly, regardless of which outcome folks would have gone with, that could have been a little extra cushion to have in the wallet. Think about it. Since the pandemic, inflation has gotten out of control. Housing costs have shot through the roof like crazy. We've seen the grocery bill somehow seems to have magically doubled over the last few years, and there's no real debate here. A lot of people are feeling financially squeezed right now and are in desperate need of some extra cash, even just a little extra to get by. Now, of course, you're not promising overnight riches here. That's not what today's class is about. But that's an extra $300, $600, or $1,231 that could have maybe gone towards paying down the credit card, or maybe, saving up for the next vacation, or even just a little extra cash to beef up the emergency fund. Now that's great, but if you ask me, here's the best part of it all. Those examples were based on 3 different approaches, based on 3 different types of investors. And I know we've got all sorts of investors here in the room today. But as we saw with the income machine, folks would not have been boxed into only one approach that they may not have liked. Actually, just the opposite. There was a path for each type to aim for anywhere between 250 to